Welcome to the deep dive. Okay, so today we're looking at something, well, almost invisible, but potentially powering everything.
Right.
What if the real secret to faster EV charging, smarter AI data centers, even those super quick phone chargers, what
Yeah,
if it isn't software?
right. What if it's hardware? Tiny little chips.
Exactly. Incredibly small, super efficient power chips.
It's really the fundamental question under the hood of so many tech advances right now. And we're looking at a company that honestly most people have never heard of, but their tech might be enabling these huge shifts.
That company is Navitas Semiconductor, ticker is NVTS, and our mission, our goal for this deep dive is to really try and crack the code on this financial puzzle they present.
Here's a puzzle, a real paradox.
Because look, right now the numbers suggest they're losing quite a bit of money, but the valuation is sky high. Investors seem to be betting big that this company is the future engine for AI and EVs.
That's the core tension, absolutely. And to understand why the market might be thinking that way, you really have to start with the basic problem Navita solves.
Right. And it's a problem everyone listening has felt, literally. You're using your devices, plugging things in, but
Yeah.
there's just so much wasted energy.
Precisely. That heat coming off your laptop brick
Hmm.
or your phone charger warming up, that's wasted energy. Usually it's down to old school silicon chips in the power system. They're just not very efficient.
Slow and leaky, basically.
You could say that, yeah. The Vitas saw this kind of overlooked inefficiency, and made a big bet. They decided, let's ditch traditional silicon. Let's go with next generation materials.
And these are the two key names to remember: gallium nitride, or GaN,
Giganin?
and silicon carbide, CTAC. Okay, can you give us a quick way to picture the difference? Like, what's the core job of each?
Sure, think of it maybe with vehicle analogies. Traditional silicon, that's your reliable family sedan engine. Works okay, but it's not setting any speed records.
Got it. Standard.
Gallium nitride, JN, that's the Formula One engine. It switches power incredibly fast, maybe 20 times faster than silicon. This means power components can be much smaller, lighter, and crucially, way more efficient.
Ah, okay. So fast and efficient. Where does that get used?
Perfect for things like fast chargers, for your phone or laptop, and also really critical for powering the processors in AI data centers where efficiency and density are everything.
Okay, GaN is the speedster. What about the other one? Silicon carbide.
Okay.
Sight.
Sight, that's your monster truck engine. It's all about handling brute strength. High power, high voltage.
So less about speed, more about muscle.
Exactly. It's designed specifically for extreme conditions. Think the core powertrain of an electric vehicle, managing all that battery energy. It's also vital for big solar power inverters. So Navitas is playing in both these critical areas of the power transition.
So they've got these superior materials, but I mean, lots of companies make components. What was their specific breakthrough? Their early advantage?
Yeah, good question. It wasn't just the materials, it was integration. Navitas created the world's first integrated GaN power chip.
Integrated. Meaning,
Think of it like this. They didn't just invent a better light bulb. They built the light switch, the control logic, even the dimmer, right into the bulb itself.
okay, all in one package.
Exactly. They combined the driver, the brains, and the power switch onto one tiny chip. And that makes life way simpler for their customers. Companies like Samsung, Dell, you name it. Less design time, less complexity.
That makes sense. Easier adoption is key for getting those big contracts. But speaking of making these things, I remember reading something about TSMC. Weren't they the original manufacturer for Navitas? Did something happen there?
You're right, they were. And yes, there was an announcement. TSMC, the absolute giant in chip manufacturing, decided they were getting out of the GaN business entirely.
Whoa, okay, that sounds bad. Like the biggest player just dropped the tech.
On the surface, yeah, it looks alarming. Why would TSMC, who makes money on basically every chip type, walk away from GaN?
Right, it feels like a red flag for the technology itself.
But it seems it was more of a strategic business decision for TSMC, not really a knock on GaN technology itself. Think of TSMC as like a Michelin 3-star restaurant. Their main focus, where they make billions, is on super complex, high-margin stuff like the latest AI processors, advanced CPUs.
Okay.
Their GaN business, in comparison, was becoming sort of a smaller, highly competitive, and, well, probably not very profitable unit for them. So it's like they closed their small, unprofitable hot dog stand to focus purely on the fancy, high-margin main courses.
Okay. The hot dog stand analogy helps. So GaN tech is still viable, just not TSMC's priority. So where did Navitas go? How did they secure production?
They move fast. pivoted very quickly to a partnership with another foundry called PowerChip or PSMC.
Right.
And this wasn't just finding a replacement. It looks like a strategic upgrade.
An upgrade. How so?
Well, the deal shifts their production to larger 8-inch wafers, instead of the smaller ones TSMC was using for GaN. That means potentially more chips per wafer, lower costs per chip eventually, and just generally more capacity. It gives them a dedicated high-volume line, which is exactly what you need if you're serious about scaling up for EVs and AI.
Right, you need that volume. Okay, dealing with that kind of major shift, losing TSMC, ramping up with PowerChip that takes serious leadership, did they stick with the founder or?
They actually made a change at the top. The company was built really by Gene Sheridan. He was the co-founder, the visionary technologist who took them public.
The 0 to 1 guy.
Exactly.
Yeah.
But then in August 2025, they brought in a new CEO, Chris Alexandra. He comes with a very different background, deep operational experience from Infineon.
Infineon, wow, that's one of the biggest power semiconductor companies in the world, right? A giant.
A huge player, yes. German giant.
Okay, so bringing in someone from a massive competitor, isn't there a risk there? Like, could he make Navitas too much like the big established players they're trying to beat? Less nimble?
That's definitely a potential risk. It's something the bears, the skeptics, point to. But the bulls, the optimists, see it differently. They frame it as a sign of maturity, kind of like the Google playbook.
The Google playbook, how so?
Well, you had Larry Page and Sergey Brin as the brilliant founders, the visionaries, that's like Gene Sheridan. Then they brought in Eric Schmidt, the experienced operator, the adult supervision, to scale the company massively.
Okay, so Sheridan was the 0 to 1 inventor, and Alexandra is the 1 to 100 scaling expert.
That seems to be the thinking. The goal is shifting from those smaller consumer electronics deals towards landing these huge multi-year contracts with automakers and data center operators.
Right, the really big fish.
Exactly. And Alexandra's background, coming from Infineon, gives Navitas instant credibility with those big, often conservative industrial and automotive companies. It signals they're serious about reliability and scale, not just cool new tech.
Okay, leadership transition makes sense in that context. Now let's pivot to the financials, because this is where it gets, well, confusing. This is the paradox we mentioned. Let's look at the numbers now.
And the current numbers are pretty stark. If you look at Q2 2025, the revenue was only about $14.5 million. And while we're growing in key areas, the bottom line was a net loss of nearly $50 million. For the quarter...
Wait, say that again? $14.5 million in revenue, but a $50 million loss in one quarter.
Roughly, yes. Losing nearly $3.50 for every dollar that comes in the door, basically.
That's staggering. How on earth can a company with financials like that see its stock price jump, what was it, roughly 152% over the last year? It just doesn't seem to add up.
It doesn't if you only look at the present. The market is fundamentally looking past today's losses. It's betting on, really, three key things about the future.
Okay, factor number one.
The catalyst. The market absolutely ignited back in May 2025. That's when Navitas announced a partnership with NVIDIA. NVIDIA. For AI data centers.
NVIDIA. That's huge validation.
Massive. The stock jumped over 130% in a single day on that news. So that AI connection is a huge driver of sentiment, making people willing to overlook current losses.
Okay, AI validation is number one. What's number two?
The pipeline. Investors aren't fixated on that $14.5 million revenue today. They're looking at potential future sales, tracked through what the company calls its customer design win pipeline. And that pipeline, it stands at a massive $2.4 billion.
$2.4 billion. That's enormous compared to current revenue.
Exactly. That's the potential future the market is valuing. It represents commitments from customers who have designed Navitas chips into their future products.
Okay, so AI validation, massive future pipeline. What's the third factor?
It's that strategic pivot we talked about earlier. Navitas is actually intentionally walking away from some business. Right now, specifically, lower margin deals for consumer chargers. That hurts revenue in the short term.
Why do that?
To focus all their resources on winning those bigger, higher margin, multi-year contracts in the EV and AI spaces. Think of it like a restaurant deciding to stop serving cheap lunches to renovate and focus exclusively on high-end, profitable dinner service. They're sacrificing today's volume for tomorrow's profit potential.
Okay, makes sense strategically, but it means they need cash to bridge that gap, right? They must be burning through capital to fund this growth and the manufacturing switch.
Oh, absolutely. They are burning cash. Their return on invested capital, ROIC, is currently around negative 35%. That basically means for every dollar they invest right now, they're currently losing 35 cents on it.
Ouch. So how are they funding it?
They raise money. About $100 million in Q2 2025 through selling more stock, which, dilutes existing shareholders but gives them the cash runway they need. But it highlights the risk. This is a highly speculative investment right now.
How speculative? Is there a way to measure that?
Yeah, one measure is its beta. Navitas' stock beta is about 1.59. A beta of 1 means the stock moves with the market. Above 1 means it's more volatile. So 1.59 suggests it's significantly more volatile, riskier than the overall market average. Big swings are expected.
Okay, high risk, high potential reward. Let's really lay out the opposing arguments then, the showdown, bulls versus bears. What's the core bull case? Why are they so optimistic despite the losses?
The bulls are focused squarely on demand. They see AI data centers and electric vehicles as unstoppable trends that need the kind of efficiency gains Navitas offers with GaN and CSI. It's almost inevitable, in their view.
And the NVIDIA deal is proof.
It's a huge validation, yes. Their AI data center pipeline reportedly grew over 100% just in 2024, reaching $165 million.
Yeah.
Plus, they're already designed into actual vehicles from major brands like Volvo and Changan. So for the bulls, that $2.4 billion pipeline isn't just hope. It's the near-future revenue stream about to turn on.
Okay, that's compelling. Now, flip side, the bears. They've got those scary current financials. What's their strongest argument against this whole story?
Execution, execution, execution,
Right.
and valuation. First, that $2.4 billion pipeline, it's potential, not guaranteed cash. Customers can change plans, products can get delayed or canceled, and critically, the manufacturing switch to power chip has to go smoothly. Any delays or problems qualifying new foundry could be disastrous for hitting those timelines.
So operational risk, what else?
Competition, they're not alone. They're up against absolute giants Infineon, where the new CEO came from, Texas Instruments, ST Microelectronics. These companies have deep pockets, established relationships, and can compete fiercely on price. Price wars are a constant threat.
Right, and those financials must really worry the bears.
Deeply. That operating margin, negative 193%. Compared to a market average that's typically positive, maybe around 18%. It's just unsustainable long-term. It means for every dollar they earn right now, they spend almost $2 just running the business. That has to slip and fast.
Or they run out of money.
Exactly. And that ties into the valuation concern. The stock is priced for perfection. We talked about revenue, but let's look at enterprise value to sales, EV to sales. It's around 16.1x for Navitas.
16 times sales. That sounds incredibly high. What's normal?
It is incredibly high. For context, the market average for many tech companies might be closer to, say, 4x or 5x sales. Paying 16 times current sales means investors are assuming everything goes right. Flawless execution, massive growth, rapid profitability. There's absolutely zero room for error baked into that price.
Wow. Okay. So survival, let alone justifying that valuation, hinges entirely on successfully leveraging their technical edge.
Let's define that moat again. If GaN and seed materials exist, what stops Infineon or TI from just copying their integrated chip approach? It's partly their specific proprietary IP. They have patents on things like GaN safe and GaN fast. But the real moat, arguably, is the reliability that comes from their integration and their experience doing it.
How does integration build reliability?
By putting the driver, the logic, the protection, and the power switch all on one chip, you eliminate a lot of potential failure points between separate components. It saves customers space and cost, sure, but crucially, it saves them months of design and testing time trying to get separate parts to work together perfectly. It simplifies things and, importantly, reduces risk.
And risk is a huge factor for car companies, right?
Absolutely. Automakers are incredibly conservative about component reliability. You can't afford failures in a car's powertrain. So Navitas having this integrated, proven solution is a big deal for winning trust there.
Do they have the numbers to prove that reliability claim?
They do. They often state they've shipped over 250 million GaN chips since they started volume production around 2018. And they boast an extremely high field reliability rate, something like only 100 failures for every billion parts operating in the field. That's the kind of track record you need to build confidence and turn that massive pipeline into actual shipped products and revenue.
Okay, this really crystallizes the stakes. It's a huge technological advantage, but immense execution pressure. What's the best final analogy, then, to frame Navitas for someone trying to grasp the whole picture?
Considering the tech potential, the cash burn, the established giant competitors, the massive market opportunity,
Yeah.
it really feels a bit like looking at Tesla back in, say, 2012.
Tesla in 2012, explain that.
Well, back then, Tesla was burning cash like crazy. Everyone questioned if they could survive, let alone scale manufacturing. They were up against every giant automaker in the world, loaded with risk. But They had fundamentally game-changing technology addressing a massive need electrification. Navitas is kind of in that spot now for power efficiency with GaN and SiI. The total market here is projected to hit over $2.6 billion by 2030.
So a pure play tech leader, massive potential, but also massive risk and skepticism.
Exactly. It's that classic high-growth disruptor profile.
Okay, so wrapping this up for you, the listener, the bull case. It really rests on believing that the demand for efficiency in AI and EVs is inevitable, that the NVIDIA validation is proof of tech leadership, and that the huge $2.4 billion pipeline will convert into revenue.
Well, the bear case screams caution. The current financials are alarming. The valuation leaves no room for error. Competition is fierce, and the entire future hinges on flawlessly executing a complex manufacturing transition and scaling up production.
It boils down to one core question. Can Navitas make the leap? Can they go from being this brilliant inventor of crucial technology to becoming a truly scalable, profitable, global powerhouse in efficiency?
That's the multi-billion-dollar question the market is debating right now.
It's definitely one to watch. We encourage you, if this sparked your interest, to start your own deep dive. The ticker again is NVTS.
Decode wisely.
Until next time on the Deep Dive.